As an investor or a trader, your success is dependent on how well you read support and resistance. When people are new to trading and investing, they think there's only one support and one resistance. This is not true. The majority of people will use recent indicative price, which RIPs their money. Smart money, on the other hand, looks to objective dynamic market structure to reveal true support and true resistance inside the market. In today's video, we're going to go through a methodology that is used by the top 5%. Stay tuned, it's going to be fantastic, and it's going to save you and make you a lot of money. Hi everyone, I'm Ken from Crypto Trading KS and the inventor of the CTKS method. If you're new, a very warm welcome and welcome back, CTKS family. My goal is to assist you to become more of a financial and emotional blessing to yourself and those you love based on more than 30 years in financial markets. If you would like to know where smart money is buying and selling, please subscribe. Let's run the numbers. Looking at true support and resistance inside the market is not easy unless you have the CTKS method. The first thing you need to understand, what do these actual charts signify? What do they represent? The fear gauge of the market. When fear goes down, generally markets go up, but not always, but just on general they do. Major market indices are very important because they give the health of the economic system. When we look at bond prices and bond yields, that's a completely different $100 trillion plus market. If the stocks are going down and bonds are going up, we can see that there's a capital flight. That's very important to understand. These are not just random charts we're looking at. Gold is also a flight to safety, as is Bitcoin, which is that blue line. When the DXY goes up, it's typically because people are putting their money into dollars, not so much putting it into the stock market or the bond market or other flights to safety, but putting it on the sidelines. And this can reflect an increase in fear. We're not seeing that at the moment, but it's really important to understand. And oil is a given when it comes to inflationary pressures. Inflation will drive oil up, but when demand is not there inside the economic system, oil prices will come down. Not all charts are created equal. Tier 1 charts will move the market. They're like the engine of global financial markets. Not just in the US. You might think it's the US market, but it's all markets. Tier 1s drive everything. Tier 2 and Tier 3 give very good confirmation signals, and as a professional, you need your confirmations. When it comes to understanding true support and true resistance as through the CTKS method, which gives objective dynamic market structure, you need to know where the strong resistances are and the strong supports are. If you don't know this, price movement is chaotic and random. As soon as you know it, the veil is lifted. Pattern recognition is incredibly important. When you look at a chart like this, especially the VIX, it's just pure chaos. And what you're literally seeing here is fear in motion. But where are the support and resistance levels? And what about if we drew up all the support and all the resistance levels since 1990, which was the start of the VIX price action? What would it look like? Well, we know what it looks like because we can just flip on the indicator for the VIX. This is one of the 25 indicators that will be released in the next couple of weeks inside the service. It's very important to know your levels. What do all these levels mean? If you have a thick one, that means stronger. Thinner means less strong. Confluence of different support and resistance lines means stronger. You will see lines below, they're safety nets, and lines above, these are ceilings. Some ceilings are made of concrete, some ceilings are made of paper. Just beware which is which. If we consider that the VIX price was just here, these would be a confluence of smart money sell pressure lines trying to push the VIX down. The other thing to remember is that these areas of massive confluence create their own gravitational force. This also means the price, if it falls through, will be pulled back again, and we can see that a couple of times. It's very important to understand how these lines actually work in a practical way. The VIX is a really tough chart to look at. That's why I started you with this one. Always do the hardest things first. Now that you've got a little bit of a foundation, let's look at the NASDAQ. The NASDAQ support and resistance levels through the CTKS method are marked up since 1973. And what could they be? A lot of people would say, oh, there's a resistance level through here and there's a support level through there, and that'd be great if the NASDAQ was trading for a week or so. But that's not the case. It's been trading since 1973. That actually means that when you look at anything on recent indicative price, this is recent indicative price, it's probably utterly misleading because you're missing key structure levels. So what do we see? There's actually no resistance through there. A lot of people would have thought this was resistance. In fact, it's support. By the time they've figured it out, they've actually been liquidated on the way, and that would cause movements like this. What about this confluence of smart money sell resistance around that 13,200 and around the 13,257 mark? The sellers are so active here, the price didn't even make it up there. What happens in these cases? Price acts as a repellent. These particular smart money sell levels will push price down. Where is it going to? Well, it's going down to here, the next smart money buy area, around the 12,822 mark. And if it doesn't hold there, because that's not really that thick, the greater potential is to hold around the 12,681 level. What you will see is price is always ping-ponging between smart money buy levels and smart money sell levels, smart money sell levels and smart money buy levels. That knowledge alone can make you a fortune inside financial markets. Unfortunately, retail mindset is always about looking at only the charts that they're trading or interested in investing in. Professionals don't do that because it's suicide financially. They look at the market pulse, the tier 1, the tier 2 and the tier 3 charts. They understand the structure and they understand the price is always bounding between a smart money buy area, sell area, buy area, sell area. Price is always moving in a wave, and they always do their three-dimensional risk management, and they're very realistic as well. Therefore, when we look at the NASDAQ, we understand there's a lot of smart money sell resistance up there, but recent indicative price typically won't reveal it. It will reveal the wrong levels. Let's look into the DXY and try to understand what's happening here. With normal technical analysis, and that's not CTKS technical analysis, which is a quantum leap in improvement in TA. Normal TA would just basically say, oh, okay, you've got a low here, a higher low. I'm going to draw a line through there. Oh, we're losing support. It's all over. Oh, what about here? High, higher, high. This is an uptrend. Okay, I'll draw a line from here to here and we'll see what happens. That's one way of doing it. But of course, you can also do that. But the key is to understand, where is objective dynamic market structure? Where is the true support and true resistance inside the market? How is price navigating around that? Do we have negative air? We've got decreasing negative air here. That means there's an upthrust potential inside the DXY, which could confirm a spike up in the VIX. But what about this? This is a smart money buy area because there's confluence around here at around the 104.011 mark. What does it mean? If the DXY sells down, we would expect it to get caught around this level, and there's a stronger one below it. We know the price is always bounding between smart money buy levels, smart money sell levels, smart money buy levels, smart money sell levels. You just use this application of your knowledge to figure out where next. Before I started the CTKS Masterclass, I saw that nobody, literally no one, was overlaying their charts with relevant price action. Now you see a lot of people doing it. One thing that we look at with the DXY, what is this red line? That's the VIX, that's the fear gauge. Do you notice any association between the fear gauge and the DXY? Please let me know in the comments. This is how you stack probabilities. As we go back to the NASDAQ, I've overlaid the VIX here. Do you see any associations between the VIX and the NASDAQ? Again, please let me know in the comments. Why am I asking you to let me know in the comments? It's all about active learning. The way that you get synchronized in with the market is that you must understand, you must do the learning, or you will lose money. A lot of people will invest in a specific stock inside the NASDAQ, but won't bother looking at the NASDAQ itself. On the weekend, I put out inside the CTKS Method service the levels that we're expected to look at for the next week. And I noted when the 10-year yield was coming up like this, I said there was a good chance that we would see a drop-off in yields. And that's what's happened. And the potential for Bitcoin and gold to turn around and to do quite well. Gold's been doing very well, and Bitcoin also came up. We can see Bitcoin's going through a bit of a retracement now, but all price moves in a wave, either going up or going down. Let's have a look into the 10-year and let's see the objective dynamic market structure on that. The US 10-year yield has been trading since 1912. Wow, that's a lot of support and resistance to mark up. When we look at the particular short-term price action of the US 10-year, we can see it's just wobbled around and just dropped below. But how does this relate to objective dynamic market structure? Where is the true support and resistance inside the market for the US 10-year? And you know that it really matters, because when the US 10-year yield comes down, it's very likely that Bitcoin and gold will both rally. And that's exactly what they did. If you're in crypto and you're not looking at the US 10-year, or you're in gold and you're not looking at the US 10-year, or you're in silver and not looking at the US 10-year, you're in trouble. We can see that ping-ponging. It tried to get through this resistance level and then had a heavier one above it at 3.689%. And what did we see? Maybe a lot of people thought that this 3.618% was a long way away, but we know how the price works. It's always bounding between a smart money buy area and a smart money sell area. Smart money buy, and if it can't go up, it's going down. Therefore, we understood that the US 10-year was encountering that strong resistance and it's making its way down. And of course, members of the service can see much, much more than what we do inside the community channel. What about gold futures or the gold price? What we can see is gold going up. But what is gold's objective dynamic market structure? Where is the true algorithmic support and resistance levels? The first thing that we note is gold has been trading since 1833. That means the CTKS method has marked up everything from 1833 to the current time. We're not looking at recent indicative price when we draw these levels across. But where are the levels? Well, let's just flip on the indicator from the CTKS method service subscription. What we can see is there is reasonable support at 1939 and also around the 1936-37 mark. This is a confluence. When price was above, if it sold down, it was likely to get caught by these particular levels. We can see another one down at about 1928, 1929. It didn't get down there. This is called positive air. What you will see, if it doesn't come down, it's going back up. If it doesn't come down, it's going back up. But back up to where? This is the million-dollar question in financial markets. If you can understand where it's going to from a probabilistic stance, wow, you're just cooking. So we can see this 1954, 1955 mark is very important, and price is pinging between that and a higher one at the moment around the 1961, 1954, 1961, 1954, 1961, 1954, 1961, and it eventually got further up to this 1973 mark. It's just coming down back to the 1961 level. You can see how this takes all the stress out of knowing where the true levels are. A lot of people will draw up a chart over basically just recent indicative price, and that's not back to 1833, and they will say these are the most important lines on that chart. That's absolute rubbish. They're not the most important lines. Objective dynamic market structure is the most important lines because price is going down or it's coming back up. And it's a very, very simple rule. If it gets above it, it's going to the next one. If it falls below it, it's likely to fall below it to the next one. Not all the time, because stronger is gravitational. That's why you must know the weights of the lines. Inside the CTKS Masterclass, we go nuts about interrelationships between different variables. What is this line I put on? Well, let's check it out. What is it? It's the DXY. And do you notice any kind of relationship between gold and the DXY? If you don't know where the DXY is going, do you know where gold is going? Please let me know inside the comments. Gold's best friend, silver, trading since 1802. Where is the smart money buying and selling with silver? You can see a massive amount of confluence, smart money sell area at 2370. This is going to be hard for silver to break through. In fact, silver hasn't broken through this 2360 level as yet. It's being supported currently at around the 2350 level. But if it falls, where is it falling to? Potentially back to the 2291 level. One thing that you always want to look at, do not just analyze the chart that you're trading. If you are just trading silver, you must look at gold. When we look at gold, we can see that association between silver and gold, and we know the DXY is playing into gold's price action. So you just can't look at silver, you must look at gold. But you can't just look at gold, you must look at the DXY. And if you're looking at the DXY, you must look at the US 10-year. And how about our friend the VIX? You need to look at that too, as well as all the tier 1 charts. Bitcoin is very risk sensitive. You'll notice that that blue line in the background had a bit of a wave down. And just remember that when you come to downtrends, you can get uptrends inside downtrends and downtrends inside uptrends. Bitcoin is a tier 1 chart because it's highly risk sensitive. Where is the true smart money buy and sell levels? We can see the Bitcoin currently trading at $27,066. We can also see at 27,940 there's a lot of algorithmic sell pressure there. Price did try to get through it, but it was caught by one level and another level around the 28,100 level. It did spike up, but it didn't manage to hold that lower, thicker, more impressive support level, but it became a sell level as price went below it. Tried to get above, no luck. And where is it coming down to? The next lower one, around the 26,610 level. Just bear these things in mind. If price doesn't get above, it's going back. If price gets above, it's going forward. I've just overlaid the S&P 500 futures. Do you notice an association between the S&P 500 futures and Bitcoin? Yes, there is definitely one there. Please let me know in the comments. This is all part of your active learning. There's a big difference between sitting back and listening and sitting forward, taking notes and participating. Your money is on the line, so it's really important that you do your active learning. That will raise your synchronization. Professionals use three-dimensional risk management, and they understand that the market is composed of millions and millions of people from all around the world. When you buy, somebody else is selling, but they may not be selling for a reason that includes losses. They may be banking in a profit and you're helping them. There are millions of reasons for buying and selling inside financial markets. If you're trading and investing, you're not taking money away from other people when you get in or get out of the market. What actually occurs is the market pays you for your synchronization. That's it, full stop. The market pays you, not other people. A lot of people don't want to trade because they say, oh, I don't want to disadvantage other people. I don't want to take money away from another person. But what if that other person was locking in a profit? You're taking away their profit. It's really helpful to think that all financial markets, it doesn't matter what market you're in. You could be in commodities, gold, silver, oil. You could be in Forex, the different currency pairs, or you could be in the stock market or crypto or whatever market you want to be in. The issue is markets always pay for synchronization and they punish desynchronization. You can see how on earth could you get synchronized if you don't look at the number of charts that you need to look at. Synchronization is impossible by only looking at the chart that you're trading and investing in. When people understand this, it's like a light bulb moment. They understand, wow, everything is interconnected. For example, we were just talking about Bitcoin and the S&P 500. What we need to understand, where is the S&P 500 going now? Let's just look quickly at the S&P 500's CTKS Method standard certification. The S&P 500 has been trading since 1871. With the CTKS method, we mark up all the support and resistance levels since 1871. So where are they playing out? Let's just pop on our monthly service subscription indicator. And when you get this indicator, if you do not keep your subscription active, the indicator will cease to work. So just please be aware of that. What we can see is around the 41.61 level, there's a bit of a concrete floor and price is gravitationally pulled into that. If we get a spike in the VIX, we would expect to get down to this level. But the S&P 500, when it gets close to this level, actually pushes the VIX the other way. Knowing how to understand and how to read these different charts, how they intercorrelate together, is vitally important to your success. I'll give you a quick illustration. This is the VIX, the red line. As the S&P 500 was coming into that smart money support, that positive air, the buyers are strong in this one. What happened to the VIX? It got pushed down. But as price got away, the VIX started to push up. If we're seeing the VIX starting to gain momentum, we would expect the S&P 500 to come back and find a level of support around that 1461 level, and then the VIX would be expected to come down again. There's so many things that you need to know when it comes to financial markets. The first one is know your tier 1, know your tier 2. They're vitally important. Even if what you trade or invest in isn't in those, you can see how it impacts the entire market. If you're just seriously looking at the few charts that you're interested in, you're already in a massive amount of trouble. If you're using recent indicative price, you will RIP your money. RIP and SBA go together. What's this fairy doing here? Well, that's the fairy of story-based analysis. Story-based analysis has many facets. All of them potentially lead you to lose a lot of money. Many people think that drawing up ODMS, Objective Dynamic Market Structure, those horizontal Standfield lines, or SLs that you previously saw, is very, very easy. No, it's not. It's not very, very easy. It takes a lot of skill, and there's certain ways that you must do things. Inside the CTKS Masterclass in LV26 is Level 1 Standard Certification, which is all of these particular videos to show you how to do just the basics. This is just the fundamental. And then when you go to level 2 standard certification in LV27, here are all the rest. To draw up these lines is not an easy thing to do. A lot of people think it's very easy. It's always easy until you know what you're doing. And then it's hard until you master it, and then it becomes easy. When understanding support and resistance levels, if you do not apply Rule 446, you're going to be at a desynchronized state at the market. All markets are intercorrelated and interdependent. And we saw bond market, stock market, commodities market, the DXY, the currency markets, they're all interdependent on each other. The focus of the masterclass is to bring all these interdependencies together, and it's a pretty big thing to do. The masterclass is huge, but it's incredibly well received. If you pop across to the testimonial section, you'll see the feedback from many different people who have been through the masterclass. I won't go through and read any of them, but it's just good to know that a lot of people have found it incredibly useful. To know support and resistance, you must have your foundations. You need to know how the charts intercorrelate with each other, how to stack probabilities. Then coming in, you need to find the market's focus, enhancing your pattern recognition. But before you buy or sell, mastery of emotional control is utterly vital, or you'll fall into the retail mindset, which is where all the losses are. Mindset causes losses, first and foremost. Then, there's so many ways to buy and sell. I would like to thank the Meditative Mind for her very kind generosity in offering a CTKS Partial Masterclass Scholarship. I will be deciding that awardee within the next week. If you would like to apply for the scholarship, the link is in the description of this video. And thank you again to the Meditative Mind. I hope this video on support and resistance has really helped you. You can shortcut so much learning by just knowing what those levels are, because they're drawn from the inception of price history on every single chart, and that's a huge amount of work. But you don't have to do that huge amount of work. You can just grab the indicator. You can become a monthly member of the CTKS Method service at ctksmethod.org and receive the 25 indicators for the Tier 1, the Tier 2 and the Tier 3 charts. Of course, more charts are coming. Those indicators will be coming out in the next couple of weeks. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.